Hi, it's Tim Quast for Market Structure Edge, and I'm sitting here on the dolphin chair of New Beginnings, a 70-foot catamaran, and we're here in Ricketts Bay. You see the boats behind me, just off of Green Island in Antigua. Antigua's one big main island, but then there are a bunch of smaller islands. And of course, we're out to sea when one of the greatest market structure events in modern history occurred. These crazy moves in GameStop and AMC theaters and Bed Bath & Beyond and BlackBerry, and it's moving into some others now. And of course, all the discussion is about why these things occur. And to me, it can be boiled down to two simple things. There is market structure, the rules that govern how stocks behave, and the behavior of money that drives them. And then the mechanics that occur behind the scenes, where as shares change hands, when all of the music stops and somebody is seated in the last chair, who's holding the bag? And the firms that handle what is called clearing and settlement behind the scenes, clearing the movement of stocks and making sure that money follows properly, and then the shares change hands. Those people don't want any liability. So as the frenzy mounts, then they become concerned about liability, and it's the broker's responsibility to make sure they don't get out over the skis, and that's what leads to things like Robinhood deciding, well, we're going to constrict trading in these things. They have legal responsibility for that. And then market structure. Here's the beautiful thing about Market Structure Edge, and you can look these stocks up and see it. It doesn't matter how extreme the movements in prices, how bizarre the chart becomes. It's not the way that Market Structure Edge looks at things. It looks timelessly at a 10-point scale, and how short volume moves above and below 50% and above and below trend. And it is impervious to those big swings. And it will still tell you when there is opportunity and when you need to be concerned about mounting risk, and I'll show you those things.
Okay, let's pick up on the background that I offered from the boat on how to think about these situations where we've had extraordinary displacements in stocks like GameStop, AMC Entertainment, and so on. And they're on my screen here, and you could do this too. Create a portfolio. You can put these things in, and you can see how this works. I want to add one thing about clearing and settlement. So I explained this on the Benzinga pre-market prep show on February 8th as well, that for a brokerage firm, the positions that the customers of that firm hold are viewed by a clearinghouse as a portfolio. And there's a trade day +2, T+2, to settle those trades. And when there is just a mania, a fervor that causes tremendous moves in stocks, an increase in volatility, in other words, then during that T+2 window, the clearinghouse doesn't want to be responsible for the financial consequence of trades that don't settle. Can somebody not make good on either delivering the stock or paying or one of the two? And so then the brokerage firm has to put up a deposit. And when there is a concentration of activity in very volatile stocks like we saw in the last couple of weeks, what happens is a brokerage has to put up a lot more money. If they don't have it, they have to cease trading. That's what happened in Robinhood's case, for instance. Okay, so with that background, let's talk a little bit about what happened. Let's look at AMC here. We're going to use one example. So here's what happened. This is what I love about market structure. Here is price. This is the price of AMC, and notice these extraordinary moves that occurred in price. Well, market structure sentiment doesn't do that. It doesn't gyrate. It's always going to be between 1 and 10. And so it continues to give you such an emotionless, an objective way to think about whether stocks are more likely to rise or fall. And when sentiment is slammed against the ceiling like that, well, stocks tend to hold their gains. When it begins to mean revert, then the stocks can decline. This is short volume. So when short volume is above trend, then stocks tend not to do so well. When there's an incredible drop in shorting, then what happens conversely to price? The price skyrockets. This is that short squeeze, quote unquote, that we heard talked about. And more than anything, it reflects a paucity of the stock, an unwillingness of people to lend or to be short the stock, either direction, and the sudden uncertainty of the price of options. All those things compound and cause prices to destabilize to the upside or downside. But you can see, I mean, had you known that clearly the best time to buy this would be, say, on the uptick or even the rise over 5, and then probably when it returns. And note that short volume is very high here. It doesn't mean that this is over, but it means that the conditions that caused it it can all be clearly seen. Let's buy it back up a year. When the stock's above 5, it does, it does very well. When it's not, it doesn't. And it's a very consistent theme, no matter what else is going on. You can see these serrations in short volume here, up, down, up, down, up, down, with the trend down. That is what caused these extraordinary spikes. So really, the movements were occurring before there was a furor in all the Wall Street bets at Reddit and so on about this short squeeze. And this would not tell us precisely that it's over. It tells us it's probably nearing a conclusion. But the beautiful thing is you can see this is supply and demand. And so long as demand exceeds supply, there's an opportunity to reap gains. I want to show you this through Profiler. This is our backtesting engine, and it's such a great illustration. So we'll put in AMC, and let's do the same thing and back up a year. So let's go back here to, let's say February, 7th? February 1's fine. And then this gives us a full year, right? So if we generate those returns, see it produces a 290% return, while buying and holding that stock would have been a 6% return, and SPY was up 16% over that time. Now we look at how much time it spends above and below 5. It's a lot less time at once, so maybe we want to buy the uptick. Does that improve our returns? It sure does. Now we're over 300% just trading the stock when it ticks up, and when it returns below 5. Just doing that would produce a 317% return. And you don't win every time. There are losses and huge gains with losses, very steady behavior back in the summer. But this way, you can very consistently get a return, and you know when to come and go. And if short volume jumps, well, then you have to change your view. But my point is that it's the supply and demand which is what Edge is going to measure, not the headlines, not the causes, not the validity of drivers behind prices or the reliability of those headlines. It's really about supply and demand, and it strips all that out, and that's how you can do it. You can look at any of those stocks in that group the same way. GME, BBBY, NOK, BlackBerry, BB, I think it is. All of those crazy stocks, and anytime there is one where there is this furor that develops, you can look at that and see what the supply-demand equation is and how short volume varies inversely with price. And you'll likely know if the stock has staying power or not, because it's all supply and demand.